Let's get going. It's 11 o'clock, I think. So our guest this week is Stuart Widdowson, who you may remember was on earlier on this year, but we're going to have a catch up because there's been quite a lot of activity within his fund and the UK small company sector as a whole. So news though this week, I pulled out three things. There's a whole bunch of results and stuff, but these sort of leapt out at me. VPC Speciality Lending first. So it's done a decent-ish job. The chart here is obviously the NAV. They're just relatively flat, but obviously it's pumping out huge or significant dividend yield, about sort of 8p a year recently. But it's never really managed to trade around asset value, as you can see, for the last 3 years. Obviously, everything panicked out in March 2020. But still, there's always this sort of persistent discount gap, which some shareholders are understandably a bit miffed about. Within that sector, though, everything is trading on a discount at the moment. I don't think that's deserved. We've talked a bit about Riverstone Credit, and it's now completed its transition to becoming a sort of sustainable lender. So it's not about sort of oil and gas at all. It's more about energy transition companies. And I would have thought the combination of that and the yield at 8% would have encouraged people to buy that one, but not so far. Biopharma Credit, we know, is done really well and keeps getting these sort of early repayments of debt, which help boost its income and its NAV. For some reason, that still trades at a discount. I don't really get some of these, to be honest. So I would have thought the sector ought to be narrowing, but why it isn't, I don't know. In terms of returns, you can see some of these returns are pretty good. So Riverstone up there. SME is obviously winding its portfolio up, so that's boosted by the effect of that, really. VPC doesn't look quite so hot. I'm going to explain why now. But obviously, looking longer term, it is the best performing one over 5 years, and there's a good reason for that too. So it's making, I think we talked about this not more than long ago, so it's making asset-backed loans to lenders who then lend on to mixed consumers and small and medium enterprises. It manages to pick up equity stakes sometimes as part of its lending process. It kind of builds those into the structure. As I say, it's been paying like a steady kind of 8p per share dividend, but that hasn't been covered with revenue recently. And I think, again, there's no good reason why they keep paying out uncovered dividends. They either need to cut the dividend or address that issue, I think. This is what the portfolio looks like. So actually, debt part of it is only about 2/3, but there's convertibles and preferreds, which are obviously debt-like things. But it's got this sort of equity stocks, common stock here, warrants. So it's a right old mix of things. And that's partly because it ended up with stakes in some of these special purpose acquisition companies. And those things have sort of been flying in and out in terms of like where they're valued. They weren't, these are not investments. They came along with lending that they were doing. But they turned out to be quite valuable for a while, and that's part of the reason that drove the NAV higher. And you can see some fairly chunky numbers here, like sort of a 14% rise in October 21. That's all driven by these things like these SPACs came on. But obviously, this unwound post that. And if you look at the 12-month returns, the revenue return has been 14.4% on NAV, which is obviously pretty good. But the capital return has been negative, and that's the value of these SPACs and things dropping. So there we go. This is what's been going on. That's what's been driving the fall in the NAV. The company points out, and I completely agree with them, but the underlying business of lending and collecting the income from lending is still going along okay. And this is sort of a distraction, if you like. It was a positive distraction when it was all going up, and now it's a negative distraction when it's going down. But that shouldn't affect your attitude to the fund generally. So actually, it feels though, for the most part, investors seem to be quite happy. It's notable that in the AGM, there was almost like sort of 100% approval to all the directors to be elected. Only one of them had a minor vote against, and that was only 3%. But two activist investors, Stord and Ritage, wrote to them in September, just saying, you know, we got some ideas that we think might help with the discount. Didn't really manage to get much action on that, and so they actually put a requisition in on the 6th of December to try and get what they wanted, and the board's going to make an announcement about this. So the 2nd of September letter reiterated the point that they're long-standing shareholders. It's always important thing to get this across. They wanted to replace a planned 25% tender that's already sort of agreed and that's going to happen after the AGM in 2023 with an option to get out 100% realisation opportunity in 2023 and then every 5 years thereafter. They were moaning about the discount. Obviously, that's a genuine thing. They were saying the deal needs to be covered. That's a genuine thing. They were saying they were concerned about keeping controlled by a fund committee with the manager. There's SBS opportunity thing. I think that's a bit sort of a slight red herring, but there we go. Because obviously, if the fund shrinks and they don't shrink their stake, then that percentage voting rights goes up. But you know, there we go. So what they actually have put the requisition in, we don't know the text of the requisition letter. I haven't seen it published anywhere yet, but we think what they're doing is they're trying to codify this realisation opportunity thing. I think that there's one good point that they raised that makes sense to me. It's not obvious how you would fund a 25% tender without skewing the portfolio, because obviously some of this is very liquid. Not all of the debt is actually. I mean, some of that debt is sort of locked up. Some of it is quite illiquid. And so freeing up 25% of the fund to fund a tender, I don't think it's going to be easy, and it might sort of skew the percentages weightings of these things if they're not careful. So part of the idea of the realisation opportunity is that you just take a slice of the whole fund, put it into a realisation pool, and then sell it off over time. It's a much neater way of doing things. And I think even if they did a tender, that would be a better route than trying to actually raise cash ahead of it or you know, just after it. So there we go. That's VPC. RTW then. We've talked about some of these biotech things recently. Big sell-off in these, all kind of post the COVID euphoria stuff around. We've discovered vaccines and it's wonderful, and all this money poured into biotech and then sold off again. Discount widened out recently, but discount's widening out because the NAV is going up. Because we've had this sort of recovery in biotech sector as the M&A activity has picked up, and also just investors got a little bit more warmer to the sector really. Here again is the whole sector, and you can see the discounts on here. Adams is a tiny thing, so it's really not worth really worrying about. But RTW's is actually the biggest of the lot, and I think that's a bit undeserved really. And what's happened recently probably just proves that. In terms of its 3-year numbers, it's still not bad. It's definitely a lot better than Syncona, which is its principal competitor really. But Syncona's done much better recently, and that might be why the discount on Syncona is tighter. And its portfolio, it's trying to establish new biotech companies, so it helps sort of fund these at the beginning. And these are its core holdings, if you like. Some of these then go on be listed, but they're still their core holdings, so they still hang on to them. And to keep the whole thing fully invested, they just invest the balance in publicly listed biotech. And it's a mixture of early and mid-stage biotech stuff, and that's part of the reason it's sold off, because obviously all growth companies, especially unprofitable things, sold off. But nevertheless, there are reasons why this thing is going up again. This is its portfolio. at the end of September. And you'll see there Prometheus, which is a 8.5% position. This is actually not in any order. I don't know why I did like that, but there we go. But I think it was the second or third largest position now. And this is the thing that's causing the excitement at the moment. So it's been developing this monoclonal antibody, which tackles problems in the bowel, really. So ulcerative colitis and Crohn's disease. And they're into phase 2 trials of these things, and they've just had the readout of those. And actually, the numbers look pretty good. They're actually quite excited about them. Obviously, it's not a complete cure for the ulcerative colitis thing, but that's a much better improvement. But the Crohn's disease one is actually really quite impressive. So both of those are now going to move into phase 3 ahead of getting approval and being rolled out. This is a listed stock, and this is what the share price did. Bam. So from sort of 30s up into 117 in a day. This adds, we think, about 16.7% to RTW's NAV. So RTW share price is up this morning, but I think it's going to go up a bit more than that, and we may even encourage discount to narrow on top of that as well. So there we go. These things can be exciting when they come right. Syncona, it's got good news in one of its investments as well, Autolus, which is another listed company that it's been listed for a while. The share price is disappointed, really, but it's got a good readout in its trial it's basically taking T cells, means immune cells, and adapting those to target cancer cells. And it's using that to try and treat this form of leukemia, this kind of aggressive form of leukemia. And again, a remission rate of 70% is really pretty impressive. So that's great news, obviously, for anybody who's affected by that. But for the company, it triggers a release of some funds from Blackstone Life Sciences, so they get an extra $17 million from that. And because they need more money again to finance the rollout of this, they've also raised another $150 million, issuing shares at $2 a share. Syncona put up 28 million of this, and its stake there is now 18.5% of Autolus. Well, it says they're worth 54.8 million. There's Autolus' share price. So basically, it's going the other way. So it was 2.99. It's after I was trading because of this massive issue at $2. That's fallen, and it's now, I think, about $2.30. It was last night. So we'll have to wait and see where it opens today. But I do think that this is going to be accretive to Syncona's NAV too, which is obviously good news. That's enough from news.